Major funding for this program is made possible by grants from Bank of America and Perfect Building Maintenance, Greenberg Traurig, LLP, New York Community Bank, Kilroy Metal Products, New York Window Company, Capital One Bank. Additional funding for this program is made possible by grants from Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, Cushman & Wakefield, First American Title Insurance Company of New York, F.J. Siami, Friedman LLP, Gemini Real Estate Advisors, Hal Fettner Durst Fettner Residential, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Madison Realty Capital, Meridian Capital Group, M&T Bank, Massey Knackle Realty Services, Muss Development, Newmark Knight Frank, Sterling & Sterling, Stonehenge Partners, the Moynihan Group, Urban American, W Financial Mortgage Fund.
Hello, my name is Michael Stoller. It's the fall of 2009. People are telling me that the recession is over. There are other things happening. It's really great out there. And there's this money for real estate. So I have these guys today, the demons, the kings of real estate, who are going to tell me, and they're going to show me the money for real estate. My guests today include Gino Martocci, who is the Senior Vice President for M&T Bank for New York and Long Island, Rick Lyon, Executive Vice President of Capital One Bank, Jim Carpenter, Senior Executive Vice President and Chief Lending Officer at New York Community Bank, and last but not least, Roy Chin, who is Senior Vice President and Regional Real Estate Executive for Bank of America. So since you are the biggest bank over here, I mean in size, I mean not the biggest person over here, you know, I have lost weight for the new season, but what kind of lending? Are you lending?
Bank of America has been, continues to be committed to real estate industry. I would say in the first half year to date, Bank of America nationwide, we've probably done about $9 billion overall. It's a broad platform. If you look at the investment banking side, you recall, I'd say around April, the REIT industry has been dying for equity. And since April, there's been probably $15 billion of equity raises on the REIT side, and Bank of America Merrill Lynch has been involved in 65% of those transactions. On the home mortgage side, I read a survey recently that said Bank of America has probably a 20% market share. So yes, we are lending. But I think to get to your point, you know, the real estate demand on the commercial real estate side has actually been quite soft. And primarily because our clients are not asking for money.
Do you see that happening, Rick?
Yeah, I'd have to echo what Roy's saying. I mean, we put out, in terms of direct portfolio loans to our real estate clients this year, about 500 to 700 million. But demand has dried up. We're doing a lot of refinancings. We're trying to help our clients with it's refinancing our own loans or refinancing other loans that they have that are coming due where the life companies may not be in it, or it may be a CMBS loan that was done a number of years ago and it's time to renew that loan. But we're not seeing the demand that had been typical of the marketplace.
So people aren't really asking for that demand, but when people come to you, have the rules changed? You know, have you improved? You know, because in 2006, 2007, everybody was out there. Banks that we discussed before, Pacific National, who's no longer in business, Builders Bank, Chorus, Fremont, all of these people were out there, and they would say, "You a real estate person? I'll give you as much money as you want." So how do you look at it today? How are you underwriting a loan? Are you saying to someone, do you have to give me recourse? You have to guarantee the loan? What are you saying? What kind of rates are people, are they still with this crazy indication that, prime is down and LIBOR is down? They want loans at these ridiculous prices? What are you saying?
I think all the banks in this panel, even during the most heated times, protected their balance sheet and behaved
That's why you're
responsibly.
invited here today.
Behave generally responsibly. I think all of us have one or two deals probably we'd prefer not to have done. But we protected our balance sheet, and we're still lending, and we're still servicing our customers. And then implicit sort of in what Rick said.
So what I'm saying to you is this. What type of lending are you doing? I hear Rick brings up the multifamily, that's the major thing for Jim. What are you seeing, and how are you pricing loans? And when a borrower comes in, are you saying to them, hey, look, I want you to have more skin in the game. I don't want you to take out any money from the deal. What are you seeing happen?
There's no question underwriting standards have gotten tighter. LTVs have gotten lower, and in value, as difficult as it is to determine what it is, it does sometimes require that they come in with fresh equity. And fortunately, I think most of us here have built up customer bases where they're able to do that. And then the other point I think you implied really is this level of this maturity crush that's coming in, in 2010, 2011. You're looking at $250 billion to $300 billion worth of loans maturing. And if we've got customers that we've had for 20 years, we may not have all of their mortgages, but they're likely to come to us with those things. Mm-hmm. So to the extent that we have capital, we're going to preserve it for those customers.
Mike, and I think getting back to your question earlier about, are we seeing a shift in the types of deals we're doing? Certainly, I think borrowers' expectations are a lot more different than they had been in the past, and we're returning to that that golden rule principle where those with the money can now dictate more of the terms. I think borrowers are coming in with a lot more realistic expectations about what they can get, and as a result, the structures are on more reasonable terms. But as you know, we did about $1.6 billion last year. I'm sorry, $1.6 billion
the first 6 months.
The first
of
6 months of this year. Now that's well off of the pace. It's about 60% of our pace in 2008. We did $5.9 billion, and that's about a peak year for us. A lot of that is returning existing deals, but it's still we're still seeing this as an opportunity to gain market share. You mentioned quite a few banks that have kind of come off the landscape. We're seeing less competition. We're seeing smarter players in the market, but less competition. Roughly 75% of the deals that we do now are new money. And if you looked and rewound 5 years ago, I think you'd see just the opposite. We were refinancing a lot of our own deals, and in this environment, we're gaining new customers. So we look at this as an opportunity, being in a good place at the right time.
But isn't it true? People say to me, I mean, Rick and Gino and all of you, Roy, you want to deal with the families. You want to deal with the established players. It doesn't have to be a family. If you had a choice today, I was at an event yesterday for the Real Estate Lenders Association, and they said, and it was discussion of really if you had a problem of a loan, who would you prefer to deal with? Bank, insurance company, CMBS special servicer, and everybody said bank. So I'm going to ask you on this situation, if you had a deal today, who would your choice be? Would it be an individual? Would it be a REIT? Would it be a real estate investment fund? Who's the best that you'd prefer to deal with, and who's the least?
I think answering your question, I would say the two I would bracket, frankly, would be old line families and REITs. And I think I go to those because of a couple of things. The commonality is financial capacity, depth, access to capital. Whether you be a REIT, if you're a family, there's been a lot of built-in discipline over the years. Huge cash flows, huge liquidity built up. And when you're in a market like this, you're really looking to bank sponsors that have that depth, financial depth.
Jim?
I think he hit the nail on the head. Absolutely. We prefer to deal with those families with generational ownership that have ridden through the ebbs and flows of the market and have been in these types of a situation.
But you've lent to real estate investment funds, and I hate to say, I came from real estate investment fund. Some of these real estate investment funds, they're walking away from deals today. You know, they say, "Oh, we can't guarantee. We don't do this." I mean,
absolutely. We've lent to REITs. We've lent to REITs where they've come in on the equity side with an operator. You know, we look to pick our situations. We want to make sure that the operator that's driving the deal is someone with whom we've either had experience or get very comfortable with. But what I am finding is even those as resistant as they had been, the REITs and such in negotiations a few years ago, we're finding them to be a bit more malleable as we go forward.
Yeah, I would say the same thing, but it really comes down to who has the intellectual capacity to really work through issues, the financial capacity for Murphy when he shows up for the rainy day, and the breadth of chances to go to get capital. So we look at it, certain funds are very good at that, and some funds are brand new and don't have the expertise, but they could raise money very well. So you really can't classify, I wouldn't classify any one as I wouldn't do business with them. It is the top sponsors in each sector is who I would like to do business with.
I think Rick and Jim and Roy are all right, but I tell you, I will sharpen my pencil when it comes to real estate private equity firms. I mean, we have at this point at least relatively few problems, and where we do have those problems, they tend to be in that space, and a lot of times they don't have the wherewithal anymore, and some to a varying degree they have expertise. So.
And when I think it's also when folks aren't looking at the long term. If you're dealing with one of the families here, they're thinking generationally.
Yep.
So, you know, values are down now. Values were down in '92. But the Alganians held onto a building, an office building. I think they opened it up in 1992, and they struggled through that. But they held onto that building the whole way through, and now it's one of the most profitable buildings in their portfolio. So they can think long term. As opposed to a fund often is thinking in a 3-year increment. So that is an issue with funds.
You know, I have a question. You know, so I hear there's money, and I know that all of you have the money out there. Let's go to certain type of products. I mean, there's a perceived feeling that it's difficult to get any type of construction loan. On my first show of the season, when I had Mort Zuckerman, I said to Mort, I said, "You stop doing construction on 56th Street and 8th Avenue, and you decided to not do a construction job on 46th and 8th Avenue because it wasn't the time." So today, would you entertain a construction loan for, and I'm going to preface this on a variety of things. There are different type of construction: an office building, a new apartment house, a condominium, or a hotel.
I think construction loans have two major risks: construction risk and market risk. You can pretty much box out the construction risk part. The piece that has been very challenging this year has been the market risk. I've had several discussions with developers, over the last 6 months who have thought about starting projects. And frankly, the question is, why now? If you look at the slope of rents, whether it be office, retail, apartments, it's been on a negative slope. So if you pick a rental rate and you're going to establish your economics off that rental rate, the question is, what gives one comfort that that's the right level? Next month it could be 3% lower. Could be 3% higher, but based on the trends, it could be 3% lower. So I think the market risk is the one component that I think bankers and developers generally have a difficult time with today, and for that reason, new construction is not happening. Very little.
And you're not seeing a lot of requests for construction finance. I think that for the same reasons with the market risk exposure that Roy mentions, developers, owners look at it with that same perspective. We do see requests from owners that are sitting with maturing land loans that may have issues with other lenders, and they're looking to just move that deal forward.
But you bring up a very interesting situation. I was on the phone last week with a bank from Miami who is a Venezuelan-based bank, and I was asking them about their distressed portfolio, and he says, "I have some land loans." I said, "Who's going to take you out?" I mean, he said, "I have land loans." I said, "How do you?" He said, "We were going to build tract housing. We're not doing anything." How can somebody you don't know what the value of land is. I mean, land in New York City a year and a half ago may have sold for $400 a foot, $450 a foot. What do you think land is worth today?
Well, land is only worth when it's going to produce cash flow. So if you say, okay, I can get a land loan, I can get it through the approvals, and here in 2 years I can build, and in 4 years I get this cash flow. Well, now you're looking at maybe holding that land 5, 7, 8 years. Constantly pushes down the value of land. So I have no idea where land values are right now at this point in time.
Do you know?
I don't think anybody really knows what the value of land is today, but going back to our sort of sponsorship question and the old families, there's old families that will buy for $100 and $150 a foot and hold it and be happy.
And they have the capability, wherewithal to hold
Exactly.
And they don't have leverage. Without leverage,
Right.
land is fine. You can land bank, and that's how the old families over generations have gathered their wealth. But once you have leverage ticking away and interest to be paid on that, it becomes very difficult for folks.
But they do recognize sort of that intrinsic value that
Right.
that this time of illiquidity and sort of market risk and market fear is driving down those values.
Right. So the only way those deals are getting done, is either a lender with an extremely strong comfort level with a sponsor, but I think even in combination with very low leverage. I mean, it's difficult enough today to peg a value on an income property that's cash flowing, let alone land and having to think through the development cycle and ultimate absorption and delivery.
I think you bring out a very interesting point. People say, values are dropping. How do you determine? I can't figure out what the true value is of anything. And it's like looking in a vacuum because there aren't that many sales.
Right.
And values are dropping. And as you bring up the fact that on a rent, on a construction loan, there are a number of buildings, some brand new buildings that are being opened up on the west side. Some good landlords, some great developers, and some of them not as strong as the others. But they pro-formed $65, $70, $80 in rent. And now they're getting $55 or $50, and they're giving 2 months free rent or 3 months free rent, and they're paying the commission. I mean, how do you look at the value? I mean, fortunately, banks didn't have to do mark to market right now on this situation. But how do you look at it? I mean, all of you are lenders, and all of you are the head lenders for your banks.
Very difficult. You've got to look at the stability of the cash flows, and then it's a question of what the cap rate is on those cash flows, and then operating expenses are going up. So,
We're looking mostly at debt yields. And
I think that's the better point. I think the debt
you
yield.
just can't tell values, and values are a point in time. So the cap rate can move 2 or 3 points and just wipe out value. So we're lending against debt yields. Our clients are looking at debt yields when they're looking at buying a stabilized property, and I think that's going to carry the day for a while right now. But that's another reason why folks were saying, well, you banks are getting very conservative. You want to do 50% or 60% loan to value. And the issue is, well, I'm happy at 70%, but I don't want to do a 70% loan 6 months ago and now find that I'm at 90% when you have a downward slope. So you have to be constantly looking at that.
It's like the denominator
Right.
effect. It's a totally.
So nothing is going to really change until we get to a bottom and we get some kind of stabilization at where the bottom is. And I think we are relatively close to that. I don't know. I won't say we're there, but I think we're getting closer to that in terms of rents aren't really declining as much anymore. They're down, but they're sort of actual leases are getting done in the fall right now. So it seems like things may be stabilizing slightly
How do you
at a low level.
Yeah, and I guess that varies also by market sector.
And that's exactly.
Multifamily, versus office. I guess office is probably going to lag this entire process. Multifamily may come back somewhat sooner, but I wholeheartedly agree. On debt yield and cash flow. I mean, because if there's stability in the cash flow, at least that's something that we can get our arms around a lot more readily than the subjectivity of a cap rate and very few sales comps to look to. So we'll look at the cash flow. We may discount it further, and so the deal may pencil out at a very low loan to value based on a sales price. And we are still seeing sales occurring where there's increased equity going in, just certainly because we won't go to 75% of the price.
What do you think? I hear multifamily, hear office. What do you feel about retail today? Would you look at retail? I mean, because the economy and everything. I mean, how do you look at a retail type of environment to lend?
I mean, again, it depends on the type of retail. I mean, I've never liked big box. I mean, big box was great for the conduits. It's just dangerous when one goes out. It's a hard thing to deal with. But when you have neighborhood centers, so if you're sitting in Queens with 1 million people around, a grocery-anchored shopping center, it's going to lose a pizza parlor and a nail salon, and then we'll replace it with something else that'll come in. And they're tragic events for those particular stores, but those properties will make it through, and they're not over-levered. So, I mean, I think retail is you're spitting in the wind with retail right now. It's at the eye of the storm. But I think the right retail, again, can be done.
Jim?
I agree with you. We have 5% of our total portfolio in retail, and the majority of it is in New York City, in the boroughs, or out on the island. If you ask anyone on my committee if they bring a deal in, it's a big box or a single-tenanted retail deal, it doesn't get past. I've never been a big fan of that. The reason I like multifamily, multi-tenanted light industrial, neighborhood retail centers is because of the dispersion of risk. You have many tenants in there that one goes out, there's someone to come in, but a big box or a single retail has too much negotiating leverage. So we will look at them. We're in the our average LTV on our retail portfolio is at 52%. That's a weighted average across the portfolio. I would say deals that we're doing right now are in the 55-60% loan to value. Again, we're not doing them with the same speed that we are multifamily.
Gino, retail?
Yeah, we have a fair amount of retail exposure, but it's really it's like what Rick described. I mean, it's very dense urban retail. It's the local tenants. It's not the big box retailers, and and frankly, we've not seen terrific vacancy and very little stress in that portfolio today.
Two other areas.
The only thing I would add to everybody's comments is underlying all that is the sponsorship.
Right.
Retail is particularly is a difficult asset class, and while we can talk about big box, grocery. Sponsorship really has the
jewelry
expertise.
industry. This year, the jewelry industry lost more retailers than it was one of the largest industries. Yeah. And then you took linens and things, which really wasn't that truly of a big box. They went into serious retail problems, and tailors had retail problems. So I mean, you have to look at the segment of retail. I mean, I know a portfolio that you acquired. Norfolk was a big white tablecloth, as they would say. They were in the big restaurant business. I mean, today it's...
Luckily, that's not in our real estate business. But, yeah, and again, it was picking the right sponsor on a business like that. And that's a tough business. No
okay, but now let's relate to something just like retail, the hospitality industry. I mean, the beginning of the year, it was terrible. The average daily rate was down, the occupancy was down. Now, the good and the bad of what's happening today in the hospitality industry is that the euro is strong, so people from Europe are coming back. I mean, it helped Tiffany's retail sales, and it also helped the New York City sales. But for the early part of September, the average daily rate was still down 35% as compared to the high. How do you look at the hospitality industry today? Roy?
I've always had a difficult time looking at hospitality industry because it's more of a business. It's a day-to-day operation. You've got a room that's empty today. It's revenue gone. So I've never been a big hospitality lender, and frankly, I don't have the right answer for you.
Jim?
We're of the same mindset. You've got to underwrite the going concern value, and we simply don't have the expertise.
Have you ever lent on hospitality?
We have $110 million in total exposure to hospitality, and that's it's all by way of acquisition. It's just not a space we've been looking to play. I'm sure smart deals can be made.
With the right operator, I mean, if you're dealing with Richard Bourne or somebody like that.
It is, again, back to the sponsor. But like Roy said, it's an operating business. And so if you have a hotel or whatever out by an airport, which is limited services, that maybe is a little bit more real estate oriented. But when you're depending on restaurants and on bar activity and nightclub or whatever, that is an operating business, and it's very difficult to underwrite in real estate.
We have about 8 sponsors that we do hotel business with, and it's generally non-luxury. It's bread and butter. It's Manhattan
also
or Long Island.
Some of them are REITs.
Some of them are REITs. It's 55-60% leverage at origination, probably higher today. But you know, going back to what you said before, we saw a huge pickup in occupancy during the month of September. I mean, an amazing pickup, certainly from earlier in the year. ADRs, as you said, remain down, and I don't think anybody wants to test that pricing power right now either.
What about if you had a decision, you know, somebody came to you and they said Manhattan, Brooklyn, Queens, the Bronx, which one would you prefer? I mean, how's your feelings about certain places? I'm a little worried about Williamsburg, to be very honest. You know, there was too much being built over there, a lot of things.
There's a lot of condos.
A lot of condos. I think the worst place that I'm really worried about is downtown Brooklyn, with 2,735 brand new apartments coming on. If you have a strong sponsor, I'm not that worried about it. But, you know, if you're not, there's real problems. I mean, so how do you look at the different boroughs in the markets?
I'm beginning to sound like a broken record, but it's going to depend on the sponsor and what they're doing and the nature of their job.
And I think as well, second to sponsor is the deal that you're doing, the asset class. You know, how well discounted are the rents in the building. You know that, you know, we prefer rent stabilized, rent controlled buildings. So I wouldn't look at that as competition against the the condos that are you know, turning into fractured deals and turning into rentals.
Quick question, because we don't have much time. Do you see the next 6 months or the next 9 months you'll increase the volume of your real estate lending?
6 to 9 months. Yeah, I think by necessity we're going to have, you know, our customers are going to need debt for their maturing loans.
Yeah, I think we're definitely gearing to do that.
Absolutely, we're lending at an increased pace.
And you?
Yeah, my sense is that the fear factor is gone now. Confidence is beginning to build up, and I'm hearing a lot more activity from the development community, sponsorships.
So, you know, in summation, I'd say that the four of you, and that's why I selected the four of you, continue to be in business, and you have shown me the money. So I think people who really want to borrow, and if they're the right borrowers for the right type of property, have the opportunity to borrow from Gino Martocci, Rick Lyon, Jim Carpenter, and Roy Chin. See you next week.
Major funding for this program is made possible by grants from Bank of America and Perfect Building Maintenance, Greenberg Traurig, LLP, New York Community Bank, Kilroy Metal Products, New York Window Company, Capital One Bank. Additional funding for this program is made possible by grants from Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, Cushman & Wakefield, First American Title Insurance Company of New York, F.J. Siami, Friedman LLP, Gemini Real Estate Advisors, Hal Fettner Durst Fettner Residential, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Madison Realty Capital, Meridian Capital Group, M&T Bank, Massey Knackle Realty Services, Muss Development, Newmark Knight Frank, Sterling and Sterling, Stonehenge Partners, the Moynihan Group, Urban American, W Financial Mortgage Fund.